Hello, everyone, and welcome to the Sustainable Finance Podcast, brought to you by Ceres. I'm Paul Ellis, your host for these programs about developments in this fast-growing industry. Ardian recently announced the final close for its America's Infrastructure Fund at $2.1 billion US. That's the America's Infrastructure Fund 5. The symbol is AAIF V. Its team includes Mark Voccola, who has joined us today, and they have deployed more than US $1 billion in 6 investments across the energy, renewables, and transportation sectors so far. Ardian is a pioneering manager in decarbonizing infrastructure assets in line with global climate change agreements, and a major renewable energy portfolio is part of this commitment. Ardian is also introducing energy efficiency policies across all its portfolio companies. In a recent press release about the team's funding success to date, Mark said, "The market opportunity for high-quality, mid-market infrastructure assets is compelling, and even more so with the powerful tailwinds from the Inflation Reduction Act." We'll hear more about the opportunity in a moment from Mark, but before we start, I want to say a few words about our sponsor. I'm thrilled to talk about the important work Ceres is doing. Ceres is a nonprofit organization working with the most influential capital market leaders to solve the world's greatest sustainability challenges. Through their powerful networks and global collaboratives of investors, companies, and nonprofits, Ceres drives action and inspires equitable, market-based, and policy solutions throughout the economy. To learn more, go to ceres.org/podcast. That's CERES.org/podcast. At Ceres, sustainability is the bottom line. Hello, Mark, and welcome to the Sustainable Finance Podcast.
Thank you so much for having me, Paul.
I'm glad you were able to join us today. And let's begin by having you describe the investment strategy for the Ardian Infrastructure Fund. That's AAIF V. AAIF V.
Lots of A's in there. Thank you, Paul. And for us, focusing on specifically on our Americas Fund, what we're doing is the goal is to invest in a diversified portfolio of essential infrastructure assets. And again, for our Americas portfolio, that is in OECD countries in the Americas. So today that's Canada, the United States, Mexico, Chile, and Colombia. Although we'll have a focus, at least 85% of the investments will be in the US or Canada. And as you said at the start, we're focusing on 3 separate verticals. We have transportation infrastructure, telecommunications infrastructure, and energy infrastructure. And we're investing in the mid-market. So for us, our definition of mid-market is an equity check of between $100 million and up to $600 million with our limited partner co-investors.
Okay. Now, what kinds of opportunities are you seeing across these 3 sectors, and where are you seeing those opportunities in the Americas?
Sure. No, we're seeing opportunities, a lot of opportunities in all 3 sectors, and really across the geographies. But focusing first on going by sector, in the transportation sector, we're starting to see more opportunities in the electrification of vehicle fleets. So we're seeing opportunities in transportation in classic infrastructure, where roads and bridges, where there are more P3 opportunities that are coming, and we're just starting to see more opportunities there as the rules of the road for the Jobs Act, the Infrastructure Act that was passed earlier this year are starting to come out. And then I'm not sure where and there's one that we're seeing more opportunities on electric charging opportunities, which is really a mix between, I'd say, energy and transportation opportunities. Not really sure where the battery falls there, just a different use case, but we're certainly seeing opportunities there. In telecommunications infrastructure, lots of opportunities in the fiber space, and that's both long haul fiber and fiber to the home. And that's really just an extension, I think, of what we saw through the pandemic with all the work from home. There's just much more data, much more remote working. And there's more infrastructure that's required as these new data centers come online. Also seeing opportunities in data centers. And again, it's something I think we expect to see continuing to go, for decades to come. And then the energy, most obvious is on the energy side, certainly with with classic renewable investments, more solar and wind opportunities coming as we're seeing the decarbonization of the energy markets in the United States. Still seeing opportunities in natural gas. It's really more as a bridge fuel, but as power companies move from away from coal to renewables, again, using natural gas as a bridge. And as I mentioned earlier, in the energy storage space, starting to see that as more intermittent renewables are starting to penetrate the market. The batteries really allow for a more efficient integration into the system, given, again, the intermittency of those, the inherent intermittency of those products.
That's one thing that I want to spend just a little bit more time on, Mark. I think a lot of our listeners probably don't know what that storage and transmission process is about when we're talking about renewable energy sources and resources. So can you expand a little bit more on that storage and getting the power to where it is going to be used part of the process?
Sure. No, it's a great question. To really simplify it, generally where the wind generally blows in the United States across the Midwest, and the best solar resources generally are not in urban areas, and again, also given the amount of land that you need for these assets, it just doesn't really lend itself to having the resources near where the end user is. And in addition to that, maybe the most obvious statement of the day, right? The wind, the sun shines during the day, so you get most of the solar generation during the day. And generally, wind blows more at night than it does during the day. So they're nice complementary resources. But again, you can't tell, as opposed to fossil generation, where you can have more certainty of the time of day it's going to be running. Again, you're getting wind at night and solar during the day, and that's not necessarily where your demand is. So you have two issues. First, getting the electrons from where they're generated to the load centers, so generally from more rural areas to more populated areas, and then the time of day issue that you just inherently have with this. So with that's where, to your question, where there's big opportunities and material opportunities in both transmission, so just taking the electrons from the generation point to markets. And then the time of day issue, that's where storage can come in, being able to harvest the resources when they're used and move them to a more efficient time of day. And as renewable resources have become a larger part of the generation fleet, so in the US, it's about 10 or 11% of the wind and solar are about 10 or 11% of the actual generation in the US. You're just getting it to the most efficient time to be used. You need to put batteries. Use batteries to help really balance the grid and shape the generation. And the third time I'm saying now, you need to get it to where you need to pull it from the Midwest to the city centers where the electrons can be used most efficiently.
Yeah, there's I'm sure you're familiar with the Bloomberg tower in New York City. I believe it's all run on renewable energy, and I believe at least some of the sources are from solar arrays on the tops of warehouses in Brooklyn and the Bronx. That's at least some of the closer power access that they have. But this is a fascinating part of the whole energy sector, and I think there's a lot more ways that it can be developed and the power can be stored and transmitted. So I'm looking forward to Ardian's contribution to that. Now, how will America's recently passed Inflation Reduction Act influence the market opportunities for high-quality mid-market infrastructure assets?
I think the first thing that the IRA will do is it gives certainty to renewable energy developers that there's going to be an incentive scheme in place for the next decade. Historically, renewable generation has kind of been done in fits and starts that have matched the tax incentives that are in place. I'm mainly talking about the production tax credit for wind assets and the investment tax credit for solar assets. They had smaller windows, 1, 2, 3 year time periods where it would get renewed. So you'd have a bunch of developers rushing to get projects done, and if you missed the window, you were potentially out of luck, so that window would close. So now you have a 10-year runway that will allow developers, again, to more efficiently put their projects in place. I think there's also, given it's really been about 15 years now that solar and wind have been really growing, and you're seeing more of an installed base. In that time, some lessons have been learned, and some of those, around, historically, you've had storage put at the site, where battery storage at a generation site. The new IRA now allows for standalone storage incentives, which I think will be able to more efficiently place those around the grid, which should again help more assets come online. We're seeing more, around the tax credits themselves, more flexibility in who can invest in those tax credits, the transferability of those tax credits, again, just to help make the process of developing an asset more efficient. And there's no ceiling on the amount of tax credits that can be put into place. So again, it's basically an unlimited bucket. So, if you do get your project developed, you're certain to be able to get access to those credits. So I think that for regular way solar and wind is important. And I think, going forward, there's more incentives for projects maybe further down the road for things like hydrogen, for green hydrogen, for carbon capture and carbon sequestration projects. Again, capital available for kind of the next generation of technologies that, again, will lead, to the goal of a more decarbonized energy space in the United States.
Yeah, Mark, one of the things that I've been reading about the act and the way all of this is going to unfold suggests that the political dynamics are pretty much split right down the middle between more liberal and more conservative approaches to these long-term infrastructure projects. In other words, the idea is that many of the opportunities that are focused on energy and renewables and decarbonizing the global economy are providing funding and tax credits to states that are historically more conservative in their political approach. So it seems like there's, in addition to the long runway to begin with for these programs to be developed, it seems like there could be less political infighting around the actual work that needs to be done. So we'll keep track of that and come back to you and find out how Ardian's doing on that down the road. So tell our listeners now about the renewable energy and decarbonizing infrastructure opportunities that are at hand in today's market.
Yeah, again, you're going to hear more of the same from me now. But in addition, there's certainly opportunities of investing in operating assets. There's a very liquid market for trading, operating or under construction, or actually even late stage development, wind projects, solar projects, and battery storage projects, and not just projects. Investing in companies and development teams that are working on these assets and managing these assets. There's still, again, a liquid market for clean burning natural gas assets, especially in geography or jurisdictions that don't necessarily lend themselves to standard renewable assets. I'm thinking more areas that, for whatever, it's forest covered, so it doesn't make much sense for solar. You're in areas that are too mountainous, where it may not make sense for wind, that still may have a lot of coal-fired generation there. So, going to natural gas, again, it's a step in a transition towards a lower carbon footprint in the electric generation space.
Yeah, and I think it's very important for our listeners to hear what you just said over and over again, because I think when some consumers and investors think about renewable energy, it looks very attractive on the surface, and we all know that it's, as you suggested, currently only about 10% of the total infrastructure and delivery of energy. So it's going to be at least a couple of decades before we can gradually wean ourselves off of those more carbon-intensive fuel sources, and investors need to be patient about that, in my experience, and not expect too much too soon. And
if you think about it, right, the transition really started 30 years ago. It was a transition from coal to gas, and now it's a transition, to non-carbon emitting sources. And it's the United States is a big market. The world, it's a continent, right? So it's a capital intensive business, and the existing transmission infrastructure is set up in a way where the molecules the electrons are moving from areas that were rich in fossil fuels, and it's going to take a long time for that to, as you said, decades for it to continue to transition.
Yes. So now, as a follow-up to that question, what's your outlook on the broader U.S. infrastructure investing landscape for 2023 and beyond? How much of the current, let's say, oil and gas infrastructure are we going to adapt and use to transport energy and molecules from one place or another, or to another? And how much are we going to have to build in terms of new infrastructure?
That's another good question. Looking into my crystal ball, I think I think that we'll end up seeing actually a lot of the existing infrastructure maybe repurposed, and I think a lot of it will go to my point earlier on some of the newer technologies that are being put in place. So I think we have hundreds of billions of dollars worth of power infrastructure in the United States right now. And there are ways to decarbonize that over time, whether it be with carbon capture and sequestration, potentially with low carbon fuels, moving to hydrogen. So I think if that does happen on a large scale, at least in my opinion, we'll have to reuse or repurpose a lot of the existing infrastructure, and you'll probably end up with a lot of the same players in our oil and gas industry involved in that. And I think the goal at the end of the day has to be, I believe the goal is, for lower carbon. How you get there, there's lots of different ways to do it. And 30 years ago, folks probably didn't think there'd be 10% of the United States with wind and solar generation. 30 years from now, we may look back and say, have a similar view on where the market is there. So I think because it's such a capital intensive business, and because there's so much, frankly, money to be made in the space, that smart people will figure out new technologies to do things the most efficient way to reach that end goal of lower carbon emissions. Again, whether it be sequestration or capture and sequestration, whether it be new low carbon fuels, and then a mix of wind and solar power. I think there are lots of ways to get to the end goal, and lots of different people looking to do it. And the IRA is a helpful way to get some of those newer technologies started.
Yeah. And, Mark, we're not really talking about this today, but of course, outside of all the physical infrastructure that you're working on in your fund, there's all the technologies that are available, and the artificial intelligence, and all of these new ways of looking at and predicting risk over long periods of time that are more and more accurate all the time as well. So I'm very excited about the way things are unfolding in the infrastructure sector. And of course, the Inflation Reduction Act is a great contributor. I've heard, I was reading an article in The Atlantic last week that suggests that when all is said and done, that it's really worth about $800 billion of total value in terms of build out over the next 10 years. So, Mark, tell our listeners where online they can find out more about Ardian's Infrastructure Americas Fund, and how they can get in touch with you about the opportunities that we've discussed in today's podcast episode.
Sure, Paul. I mean, the best way to find out more about Ardian, you can go to our website. It's www.ardian.com. And for more specific questions on transactions or ways that we can work together, my email address is mark.voccola, V as in Victor, Occola, @ardian.com.
Great. Well, thanks again, Mark Voccola, co-head of the Ardian Americas Infrastructure Team, and to our sponsor, the Ceres Accelerator for Sustainable Capital Markets. The Ceres Accelerator is a center of excellence within Ceres that aims to transform the practices and policies that govern capital markets to reduce the worst financial impacts of the climate crisis. For more information, go to ceres.org/accelerator. That's CERES.org/accelerator. And to our listeners, join us again next week for another episode. I'm Paul Ellis, and this is the Sustainable Finance Podcast.